Well, holy smokes, the Federal Reserve just approved one of our suspicions about this nasty, disgusting market for highly valued companies with big growth potentials, like tech companies, certain consumer discretionary, certain newer companies, SPACs. Folks, this is a sector of the market we already know has been suffering a lot. Momentum's been suffering, tech's been suffering, a lot of things have been suffering. But indices continue to go up and up and up and continue to hit new records, which seems very discongruent with how many of us feel on the YouTube space, because a lot of us are investing in these long-term growth opportunities. A lot of us have been shopping and buying the dip because we know one of these days they're going right back to the moon. But here's the thing, folks. The Federal Reserve just released a sustainability report, and we got to talk about it because they just told us something that we already had a suspicion was happening. So let's get right into it. First, and in this, you're going to find what the problem was, all right? Just remember, as you go through this, you might get stressed out. So realize now you can also shop for life insurance at Lemonade by going to metkevin.com/lemonade or go to metkevin.com/life. Try both of them, but Lemonade will give you a quote for life insurance, homeowners insurance, renters insurance, and pet insurance. And check out a quote for just life insurance from Ladder by going to metkevin.com/life. Try both of them. They both offer life insurance, and this can be stressful. So let's get into it. Okay, so Financial Stability Report released by the Fed last time in November, just released today by the Fed again, states the following, quote, asset prices are vulnerable to significant declines if investor sentiment shifts. Quote, should risk appetite decline from elevated levels, a range of asset prices could be vulnerable to large and sudden declines, which could lead to broader stress in the financial system. The last thing we want is broader stress in the financial system. This isn't the secret yet. We're getting to it. Such scenarios could materialize if progress on containing the virus falls short of expectations or the recovery stalls, straining some households and firms, the report goes on to say. The report also says that other parts of the financial system appear resilient, that banks remain well capitalized, and that leverage is low amongst broker-dealers, that household debt is manageable, and that businesses are better able to service their debts as interest rates, especially variable rates, remain low. However, just like in the last report in November, high asset valuations were a potential red flag. Now, what's crazy is valuations went to the moon since November, and yeah, some of them have returned to their December points, but, you know, if you had invested on election day, a lot of the things you probably invested in would be a lot higher right now. But anyway, let's keep going here. This is where we start getting into a little bit of the devil in the details. It noted pockets of opaque risk and high leverage, particularly among hedge funds and related entities. Folks, let me translate this. What the Federal Reserve is noting is that weenie babies who do not have to disclose their short positions have high leverage and are using bizarro assets and collateralized assets and rehypothecated assets. Basically, they're using fancy crap, again, to try to squeeze a buck out of this market. What's the easiest play? What's been the easiest play over the last 2.5 months? Buy puts and short-term puts or recollateralized shorts on high valuation companies. Companies that are destroying earnings. But what's happening? Companies are destroying earnings. The companies are seeing a bump in share price. And then instantly, okay, earnings came. Now let's short the crap out of them. It's coming from the weenie babies, as we expected. And by hearing high leverage, we know, because they don't specifically say the weenie babies are shorting. But let's be real here. When hedge funds have high leverage, what do hedge funds have to do? If you're sitting on 100% margin, or you're an Archegos and you're on 200%, 3x, 4x, 5x, 8x, 20x leverage, what do you have to do every single day to make sure your firm does not go bankrupt? Every freaking day, you have to sit there and be a big fat weenie baby going short, 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 short. Because you have longs and you got to balance it out with the shorts, and then you try to arbitrage and make a little bit of profit no matter which way the market goes. Doesn't always work out. There is risk involved in all of this. This is why I don't recommend all these crazy arbitrages that the hedgies try to do. We hear time and time again about hedgies getting burned. There's always a back door that screws somebody. But folks, hedgies, they're shorting the market. And the Fed is picking up on the quote opaque risk of high leverage, particularly among hedge funds and related entities. They made too much money over the last year, and now they're hedging the crap out of all their positions, and it's hurting everything that we are investing in. Well, a lot of what we're investing in. A lot of these, by the way, are showing up in the consistently higher and higher short positions that we're noticing. We regularly take a look at shorts. I mean, SPACs, we started seeing the SPACs have their short interest positions skyrocket back in February. That's just now echoing throughout the rest of the chambers of the economy and markets. And so this is why we're seeing such green followed by such, or should I say, such green on expectations, green on amazing earnings. But any slight little word of potential downside, short, sell. Remember, folks, prices falling is selling pressure. Shorting creates selling pressure. Even a company like Etsy has seen its short interest levels go up even just over the last couple weeks. It's not a surprise that it's the hedge fund weenie babies coming out with more and more pain, going on more and more interviews, discussing, oh, you better be careful out there because, prices could fall. And then leads prices to fall. And it's all playing right into their playbook. So you're selling right now. You are playing into the hedge fund weenie baby playbook. But let's keep going. What else did the Federal Reserve have to say? What else was in their financial stability report? Well, Mr. Powell stated that the overall financial stability picture is mixed. He said that it's manageable and said it's appropriate and important for financial conditions to remain accommodative to continue to support economic activity. This obviously leads a lot of folks to say that the economy is essentially juiced up on nothing other than hopium from the Fed, and the markets believe it right now. As much as we might like to kick and scream about, oh man, we can't rely on the Fed, markets are overall believing the Fed more than they're not believing the Fed. Now, I know that seems crazy because it's like, wait a minute, Kevin. What do you mean people are believing the Fed? I don't believe the Fed. I think CPI is a joke. I think that inflation, hyperinflation is here to stay, and it's cometh. It's going to be worse than the 70s. Our dollar's going to crap, and cryptos need to go to the moon. But what continues to be a regular theme in the markets? Bonds going down. It's simple. The 10-year sitting at 1.56, trending down over the last 5 weeks. We've got the 20-year trending down over the last 5 weeks. We've got the 30-year trending down over the last 5 weeks. Tomorrow, we've got a big unemployment date. The new unemployment report comes out. That'll show a new unemployment figure. We'll know, okay, what percentage is the unemployment rate now and how fast are we recovering. Ironically, the worse the news is, the lower inflation expectations will likely be and the lower yields will probably fall. The better the news is and the hotter things appear, potentially the higher yields will go and the more problems we end up seeing in stocks thereafter. So tomorrow's obviously a catalyst date. But do we have some more insights? We do. Donald Cohn, who was a former Federal Reserve governor, said, quote, a decline in asset prices, home prices, cryptocurrency would certainly hurt people holding them, but it's not going to get amplified through weakness in banks and investment banks the way it did in 2007 and 8. And this is where the Federal Reserve is basically saying, look, believe us or not about inflation, whatever. Our take is that it's going to rotate to the downside. But don't worry, we're going to make sure that the banking system remains intact. This is something that we've regularly seen from the Federal Reserve, is that they're doing everything in their power to support financial markets to make sure that something like an Archegos doesn't take down the entire financial markets. In fact, the Archegos 20x leverage disaster that smacked banks upside the head was really a warning shot. It was a suggestion that, hey, banks, you better be as strong as you are, and you better stay that way. And that's what the Fed has been telling us, that markets are primed, or banks are at least primed, to support massive falls in market prices if they occur. But it's really the individuals that are going to be along for the ride. It's you and me that are along for the ride, and it determines whether or not we weenie baby out, or paper hand out, or do we diamond hand and take advantage of buying the dip every time we get paid. That's my point of view. Over the last few days, I've been buying. I put hundreds of thousands of dollars into the market just in the last few days as prices continue to fall, and I continue to desire taking advantage of those opportunities. That desire is not going to stop. I'm going to continue to acquire shares and shares and shares of my favorite companies as the prices fall. It's an opportunity. It's a buying opportunity for me. Whether or not inflation goes up in the short term, over the next 6 months or not, whether it goes up and then comes back down, doesn't really matter. In the long run, inflation trends down, and my long positions are going to be in great places with the shopping I'm able to do now. Etsy, Enphase, Redfin, Neo, Tesla. These are the future, folks. You can't bet against these. But Wall Street is, because they have to. Because they're so over-leveraged. They have no choice. They have to protect themselves by shorting. And in doing so, because they're all over-leveraged, these hedgies, probably, we don't know exactly, but many of them are very likely over-leveraged, and that's why the Fed's like, some pockets of potential over-leverage here. It's a problem. It's not good when you hear that. But anyway, we do continue to see that Wall Street strategists, Wall Street Journal here reported that Wall Street strategists and some investors argue that elevated stock valuations aren't a problem as long as interest rates remain low. Great, and expectations are that they'll be going up soon. And any kind of sudden change is obviously going to create some heart palpitations. But remember, the Fed's regularly saying, hey, we're not ready to even talk about tapering yet. We're not even ready to talking about increasing interest rates. So we'll see what happens. All of this to me is just a short-term opportunity. But what I'm paying attention to tomorrow is that unemployment data. How hot is it going to be? Is it going to massively beat? And are we going back to 4% unemployment way faster than we thought? It could be a problem. We get back to maximum employment soon, and very, very low unemployment, we'll potentially see rates tick up pretty dang fast again. If we see an acceleration, a surge in yields, well, I would expect Bitcoin to ride with it, and I would expect a lot of drama in the markets. But remember, folks, we got CPI data coming out next week. We got plenty of drama to look forward to over the next 2 to 3 months. And if you're investing right now, you better be buckling up. We don't know when that green is going to come, but it's probably still going to take until September to October. Thanks so much for watching, folks. We'll see you in the next one.